Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. Well, the inflation figure are the theme of the season, and possibly the dollar bulls are having a really bad day. After the US CPI print yesterday, Euro rallied more than 1%, USD&R was showing a break below rupees 83, risk assets rallied, and probability of a rate cut in May by the US Fed increased. Given the market reaction I told you, can you guess how well CPI was perceived by the markets? JK, good morning. How are you reading the inflation figures? Do you think the inflation fight is over?
Good morning. Uh, yes, it is an inflation focused times, and obviously, US numbers are the main drivers of the markets. Although we had the inflation number from India, which had moderated, then we also have CPI numbers from UK during the week. Now, US retail inflation for October is almost on all counts, and the main driver was the better than expected core CPI details with 0.2% softer than 0.3% forecast, and on a year-on-year basis 4% versus 4.1. Now the help came from moderation in rent inflation, which has been the big pain point for the policymakers, and rents were up just 0.4%. And even the lodging rents, which were indirectly contributing to the services side, also came down to 2.9%. Now, what this inflation number did was the rate hike expectations, or rather the rate change expectations, have undergone a sea change. January and December Fed meetings are almost 0% chance of a hike. In March, it's 73% probability of a no change. In May, it's a 0.25% rate cut that is being discounted by the market as against what was expected earlier in September. And the overall rate cuts for the year 2024 is now at 100 basis points, so 1 full percentage point versus 0.8% that was being discounted earlier. So not only US numbers, but also we had earlier numbers from Eurozone, which showed the zoo economic sentiment recording a good improvement. And also the unemployment rate itself in the Eurozone came down, although the GDP number showed a contraction by 0.1%. That was also expected. And overall year-on-year basis, it was 1% higher. So GDP being a backward-looking number, market did not look much at that, but the fact that the forward-looking zoo sentiment data has improved gave a big boost to the sentiment. And also in UK, data showed that wages grew slightly less in the last 3 months to September after rising at record pace previously. So all in all, setup for the market was a very bullish atmosphere, and CPI was the last thing that actually triggered the big moves in the numbers in the markets. Of course, there was a monster rally in bonds, 2-year yield dropping by 20 basis points, 10-year and 30-year by 18 basis points. Now they're all well off 0.5% from the previous highs. German and UK yields also followed. Now, not long ago, sellers of bonds were overwhelming as yields had pushed up with enhanced supply from Treasury, but that has been reversed entirely with more buying of bonds by investors emerging due to fear of missing out. It is also to be noted that markets have been easing off as most policymakers have been cautioning that if needed, they will hike more. But the steady fall in inflation across major nations should give a lot of comfort to the policymakers. The only downside to the entire move is that the financial conditions are now the easiest in 6 months. That will put Fed on their guard, because it could indirectly boost once again demand and another push to the inflation number. So they will try to keep push back against the market expectation of an early rate cut, and this duel between the policymakers and the markets is expected to go on for some more time. On the stock markets, equities investors were exuberant after seeing cooler than expected inflation. It's almost as if we had a rate cut yesterday. That's how the markets moved. Dow Jones moving 1.43% or 490 points. At one point, it was 550 points up. And NASDAQ by a whopping 2.37%. Europe 1.76%. The Asian markets have followed through with equal vigor, and global composite of index also moved up nearly 1%. Now, also a temporary resolution to the spending bills of the government, which has seen some sort of settlement between the in the House of Representatives and the Senate, has averted a partial shutdown of the government that was expected beyond November 17th, but that has been averted. That also helped somewhat in the sentiment. Currencies, not surprisingly, dollar took a tumble of nearly 1.5% after the CPI surprise, and rate expectations mellowing down a lot has given the dollar bears a big boost. Decline has come across major currencies. Euro, of course, was 1.7% higher at 1.0876 at the highest since 1st September, and pound gained 1.8%. Commodity currencies have participated in the rally too. They had been subdued for some time now, while the EM currencies have been up more than 1%. The gold moves have been somewhat muted because the gold market is seen a bit long. If you remember, gold had taken precedence in this dollar's fall when the yields were even trading above 5%. And that was the time when most savvy investors had sold bonds and bought gold massively, resulting in a 10% rally in the gold prices. And that has actually seen some consolidation. That's why you have seen the precious metal not participating much in the dollars fall yesterday's trading, but it remains very well supported at 193035 range. And it's a matter of time we see resumption of the gold rally. Of course, we have a lot of other data points today: retail sales, producer price index, industrial production, and Empire State Manufacturing. All of them give reasons for exuberant markets to consolidate. In Asia today, Japan gave a kind of disappointing GDP number, which came well below expectations, but it was made up by much better data once again from China that showed improvement in the industrial production, retail sales, as well as the unemployment situation. So this is the second successive month where China has recorded some improvement. Chinese yuan already had strengthened yesterday from 7.31 to 7.25, and that it trades still at that level. And I think after having been on the selling side of yuan for so many months, the market is somewhat reconsidering their positions, and possibly some more gains are in store for the Chinese yuan. On the Indian side, we had CPI data on Monday. Came slightly higher than the expectation at 4.87 versus 4.8%. Again, the food and food inflation playing a major part. Food and beverage inflation was steady at 6.24 versus 6.3% in September. Fuel has been a major contributor to the down move because there has been a subsidy from the government, and this has offset the slight increase in the food prices. We also had WPI inflation yesterday, showing the deflationary trend in the prices continuing, coming at minus 0.52 versus 0.26 in September. On the wholesale price inflation, the lower number was due to lower prices in the manufactured products. So these numbers are not seen enough to see the central bank relax, as the November inflation is likely to be influenced by adverse base effect, big rise in the onion prices in the middle of October that will be reflected in November, and food prices, which have already shown a rising trend. So we expect MPC to remain on the vigilant mode and keep policy unchanged for now, not to be influenced by any Fed rate hike expectations in the market. Only when we actually get any firmer indication of a Fed move in the first quarter of the next financial year, that we see RBI also getting move on. On the rupee, Yes, as we expected, the rupee slid back into its familiar range between 83.25 and 83.30 on Monday. Surprisingly, it has had a good reaction to the downside yesterday below 83 after the lower CPI number and the dollar index coming down by more than 1.5%. And that has seen the rupee now, even now trading at 83. But then again, we had a foray above 83.30 a couple of times before that, and that came back into the range. Now below 83, and once again, it's not making headway further. And I think 83.30 should hold on. Central bank should be happy with that. Two reasons. We're still not seeing any big flows that will push the USD INR much lower. And secondly, RER being still at a overvalued level, the central bank will be happy to see the rupee adjust its value even as other currencies rally. And without having to see the dollar rupee go higher, the RER will get adjusted. So all in all, a very interesting first half of the week, and we should see more action in the coming days. Thank you.
Thank you, JK. And I really like what you said initially about if we could summarize the way markets have reacted to the US CPI, it's as if Fed has announced a rate cut because equities rallied as if there was a rate cut announced. Now, of course, we have got the US retail sales, industrial production data, which we have to look forward to. Chinese data is showing some improvement, especially in the industrial production side. Indian inflation came in at 4.8%, slightly higher than expectations, and rupee slid back into its familiar range and strengthened after the US CPI number. But 83 and 83.30 range should hold as the flow-related factors remain unchanged. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.